Hey, everybody. Welcome to week 139. And guess what? Week 140 is going to be the last one of this year. So next week, be there, be square, because we're taking 2 weeks off, man. We got Christmas coming. So as you guys are ramping on here, you know the drill. Q&A is where you ask us questions. That's what the Q is for, questions. And then hopefully we have answers. That's what the A is for. The chat, I think it has been enabled. I think we got that bugaboo fixed. So yeah, it looks like, here we go. Everyone should be in. Yes, everyone. So I don't know what the deal was in case Papa Joe's on to give us static, but we're going to be talking about, it seems so perfect, these mergers and acquisitions. And we're going to talk about like what to do right and what to do wrong. And most people get the do wrong thing. So just before we launch into this thing, I've got a scenario in tribute to the Kansas State Wildcats winning the Big 12 championship, which we could not say that 22 years ago when I was there. So here's the scenario. There are two universities, same state. One has red and blue as their colors. They both have animals, if you will, breathing creatures as their mascots. The other one is purple and white. So red and blue mixed together equals purple. It should be great because one of them, the purple and white one, has the best architecture, one of the best architecture schools in the country. NC State's also very good, but it's a 5-year program. This other one with the blue and yellow is a 4-year program. It's decent, but not quite as good. But they have very similar sizes of campuses. You would think, man, like, all right, so and one of them, the blue and red one, has a much better art program. So maybe what you do is you just do this merger of equals and it'll be great. All the numbers look pretty good. You can have all kinds of consolidation and efficiencies from that. So in that scenario, and they would maybe change the name of the mascot to Wild Hawks or something like that. I don't know. Or the J-Cats. I don't know, but just a thought. So Jack is laughing. So what would be wrong with that scenario? I mean, the numbers crunchers have done it. The lawyers like Jack have all done their due diligence. There's no toxic waste except in that one place where the blue and red campus is, but they can mitigate that. So what do you do? What would be the problem with that merger of equals?
Are they really equals?
Yeah, that's question one. Question two as well. I will ask my in-laws who are graduates of K-State to see how they feel about that. I mean, that kind of like, is that like saying UNC and Duke should merge, or even
they
UNC
both have blue?
State? Yeah. But I still to this day cannot wear. There was something, maybe it was soccer related, but it was too much. Oh, I know what it was. Lowe's was giving away something, and the Lowe's blue is too close to Duke blue, so there's no way I was taking any of that home.
Oh, so, really? So
yep.
they go to Clemson orange for the big box over there then, I guess.
Yeah.
Interesting. Hey, Adam, before Jack has, I can't wait for him to go into his list. I just cannot wait for that.
Yeah.
But before we go into that, any things from a tax standpoint, we're going to be talking about mergers and acquisitions and the misnomer of mergers, I think. But from a tax standpoint, any news that you want to address, because we are getting down to the kind of wire before Christmas and all that kind of stuff, things that you need to announce or think about from the tax standpoint in an acquisition, in a merger, things that we need to be talking about. We can deal with that later on, but anything from your standpoint?
Yeah. So a couple things. First off, on the tax front, just a reminder, we've covered this in previous calls. We've had a lot of questions in our year-end planning appointments around, depreciation rules. What should I buy? What should I buy? So it's just this is just a refresher. there are two components of depreciation rules. Component number one is if I made money, I can use what's called Section 179 to automatically expense what I bought. There's some limitations around it in terms of I had to have made money to be able to use it. Otherwise, it just sits as a carry forward waiting for me in the future. And secondly, there's some income limitations, but I mean, the income limitations are so high that it's like not that many of our clients have an issue with meeting them from a phase out, with not meeting them from a phase out perspective. So then so that's 100%, but you had to have made money. And it can only be utilized to the extent that you made money. So if you made, 500 grand, bought 750 in equipment, you only get to use 500 of it, 250 waits for you for the next year. Bonus depreciation, which is the equivalent, right off 100% of my stuff, will allow you to go into a loss position. So same scenario, made 500 grand, bought 750 in equipment, I can actually create a $250,000 loss. Why does that matter? Well, if I'm owner of a business, I had W-2 wages or I had other income sources, I can be using that loss to offset those other income sources. Whereas with Section 179, I can't do that. My point in saying that is we always figure out what's the best approach to take, but that bonus depreciation thing that's 100% goes to 80% next year. So you still get a write-off the other 20%, you just get to do it over the useful life of the property. So it just, it's a long way of saying if you were going to buy something and you're going to buy something anyway, it doesn't hurt to do it this year since the rule actually will change and continues to phase down over time until 2026. So that's just, kind of one item of note. I think the other item of note that, as we're doing these year-end planning appointments, we're getting asked over and over again, continue to ask us about the recession. So again, if you guys have any kind of insights from y'all's perspective on the call, or if you're watching this later, if you hear anything, please let, me, Jack, or Gary know about it. But generally, the consensus that all of our clients have, is kind of, it's hard to say, did I have my consensus and then they had it, or did they have their consensus and then I had it, or did we all have our consensus together, which is, there will be likely a recession. We likely will not be, meaning our clients, small businesses, unless it's super niche-y, probably won't feel it in 2023. We'll feel it in 2024 as the proverbial, Gary, rolls downhill. So I'll give you a good example. I mean, kind of home builders, right? Upstream, you hear of home builders slowing down land acquisitions, slowing down new construction, laying people off. And at the same time, they've got a lot of raw land that's still in the development process right now. That's actually keeping most of our clients kind of busy through 2023, with some limited exceptions. So the pain will be felt in 2024 if there's not something else that kind of changes. So just, think through that and kind of prepare accordingly. You're on mute, Gary. We can't hear you.
Oh, sorry. I don't want to be the bearer of bad news, but man, I've heard, one of my clients has had the first quarter in their history in the red, and they serve a lot of custom home builders. And so they're feeling it, prices of fertilizer have tripled on them and stuff like that. And yet they've got some of these big builders that have waylaid and shut down new developments, as well as they're asking for price decreases, while these guys have had triple costs, and some of their costs of goods. So, and not granted, that's a niche area. People that are in the mortgage area in particular, we're seeing that too. Obviously, interest rates are a big part of that, but it just means that it's important for us to knuckle down and buckle down on what we know to do. I think, almost 3 years ago, we all had to do that, and we did. And thank goodness for some of the PPP and some of those other programs that came through. But the companies that we saw that did well had plans in place, and they were executing those plans, because nobody knew. I mean, who would have thought 3 years later we'd still be dealing with COVID or whatever? the 2 weeks went a little bit longer than that. Hey, we do have a question before we get into more on the mergers and acquisitions. And if anybody has any other questions on tax related stuff for year end, speak now or hold it till next weekend or next week too. But you got 2 weeks to deal with it. But here's the question. If you have a buyer ready, what type of representation do you need? Accountant and or broker? And I would also insert legal counsel. Right on, Jack. I'm thinking about you. Had briefly spoken to an M&A broker in the past, and their fee was the same, 10%, even though they don't have to find a buyer. Seems excessive for only needing part of their service. I would agree with that. You guys want to weigh in on that?
Sure. So typically, you know, at a minimum, you need to involve your accountant and your attorney, and I'll let Jack kind of weigh in on the stuff that you should be counting on us for in that process and when we should be engaged, because he will have a fabulous opinion about that will be better than mine, meaning like he'll just be more thorough than I will and more shaming than I will. Thank you, Jack. But in terms of the broker fee itself, you know, what we typically see in that scenario is that you just negotiated a specific fee for the broker for a specific set of buyers. If you already are naming buyers, and they're just representing you on their behalf, or alternatively, you know, you kind of, and that, you know, that could be a lower fee if it's one of these three buyers, or alternatively, you just negotiate a flat fee rate. You know, some of that's going to be dependent on transaction size, but, you know, usually that kind of flat fee rate starts at about the 10 grand range, you know, and will go up to kind of ceiling out at about 50 grand, depending on the transaction size. But, you know, honestly, it ends up being, sorry about the dog there, it ends up being worth it, you know, in terms of making sure that you got the help, because they do a lot in terms of, helping you navigate through the process. That again, could a CPA do it? Yes. Could an attorney do it? Yes. Are we very good at it? Absolutely. But at the same time, you know, a transaction broker is only working on like 3 deals at any given point in time, whereas Jack and I are working on a lot and doing other stuff as well. So they're just able to dive into the weeds more than we are in terms of like the crappy negotiation part of the equation.
Yeah, and I would say that so there, and I don't want to say that this is universal, but there, in my mind, is a difference between a broker and an investment banker, where you have a broker being a conduit and a facilitator, usually representing the seller, but sometimes the buyer is out there seeking sales and representing a buyer or seeking opportunities. And then an investment banker, which is more in depth. They help you with, or should be, I think, helping you on the front end before you even go to market, and helping you get the business to look, feel, run better. So become essentially more sexy for sale. And so, and then they would help you put together the materials to solicit bidders, so potential buyers. And they will help you through the process and getting through that. They will help you produce the materials that would be part of due diligence alongside of your CPA and your attorney. As far as when to get involved, there are many times where we get involved, in my humble opinion, too later than we should. And that's a lot of times we have an assigned letter of intent or memorandum of understanding presented to us, where even though it's mostly non-binding, usually typically the things binding in an LOI or MOU are confidentiality, potentially no shop provisions, those kind of things. But even then, you know, the purpose of an LOI and MOU, not to kind of retread what we've talked about in the past on this program, is basically to make sure that everyone is in the same ballpark, same universe, a meeting of the minds on the fundamental terms of a deal. So what is the purchase price anticipated to be? Is there going to be, like in a stock purchase, is there going to be working capital requirements? Is it seller finance? Is there an SBA requirement? all those things kind of put in. And yes, you still have due diligence and everything else that goes into a deal. But the reality is that I have done this before and said, well, you know, that seems to be a very important piece of the puzzle. Why wasn't that in the letter intent? The letter intent doesn't say that, doesn't mention that. And so why are we negotiating this at this point? We may negotiate the nuances of implementing whatever it is, but let's not create a brand new requirement that is substantive and potentially does one of two things. It shifts the purchase price potentially one way or another, or it shifts the risk, which is essentially the same thing, but in different permutations and different forms. So those are the things that you know, if we are, not that we have the magic pixie dust, but if we're involved earlier on in the process, along with your CPAs. I mean, there was one time, actually, we were going through an LOI, and I was going through it, and Adam actually brought up the working capital issue before I even, you know, had a chance to look into that particular transaction. And so, you know, it's those kind of things that come up. And so, long-winded way of answering that, earlier is better, and earlier than you probably may have thought about that. You know, I think people have the perception LOIs are non-binding, so no harm, no foul. But there is some psychology behind having as much as you can of the higher level, more important things in that LOI, even if it's non-binding, even if the deal falls apart.
So I'm going to say this not just because Jack's on here, but I would say Adam and I have seen a lot of deals, a lot, and Adam's probably seen even more than I have. But the biggest issue early on is when somebody is signing something and they didn't bring in a qualified attorney. They may have had their, you know, brother-in-law's, you know, second removed cousin who was a fraternity brother of a friend down the street or whatever, but that does not make them really well versed in mergers and acquisitions activity. And you need to have somebody that knows what the heck they're doing. And there are a number of good attorneys, and Jack is, you know, among the top ones, we think. So that's why he's on here too. But they're great attorneys, but you need to find somebody that specializes in it, and don't cheap out on the front end because you think that you're going to save a dime. You could be, you know, remember that Pennzoil commercial, you can pay me now, you can pay me later. Well, when the engine blows up because you didn't change your oil, it costs a lot more than an oil change. It's kind of the same way with engaging an attorney too late. It's like the engine seizing up. So Derek, we will get to your question in a little bit because but while we're still on topic with you know, mergers and acquisitions, so here's a question that's kind of related to that. So this is probably to you, Adam. Assuming you're selling an S corporation, please explain the tax implications of a complete sale. The owners have paid tax on the profitability over the years. Does that play into the tax expense?
You know, yes and no. I mean, the answer to no, it's like the money that you took out in the past, absolutely not. I mean, those were earnings that you made or initial capital that you'd already paid taxes on. So that was your money, free and clear, no big issue on that. But what it does mean is that your stock basis in the company, meaning like the amount of money that you have at risk, which is the starting point of calculating your capital gains tax, is going to be low. It's going to be basically whatever your retained earnings are. So, you know, real simple illustration is that, you know, if I started the company with $1,000, I made $1,000, I pay taxes on the $1,000 in year one. My basis now is $2,000. If I sold the company for $2,000, I have no gain. If, on the other hand, I distributed $1,000 out to myself and I sold the company for $2,000, I have my original $1,000 of basis for the calculation. If, on the other hand, I made $1,000, I have my original $1,000, had $2,000 in the bank, I distributed out $1,500 to myself, left $500 in the bank. I've got $500 in stock basis for the purpose of calculating my gain. That's where it comes into play.
All right, thank you. Pardon me. before we get into before we go into some of the biggest failed mergers in history, which that's an interesting list, and I've got experience with one of those. Derek has a question. What do you consider to be the best sources of information to make the determination that a recession is coming? Besides TikTok, Adam, what do you think?
Bubba in his basement. There's a real dude down here in my basement going on. I'll tell you, you don't need nothing on that fake news. That was horrible. I'm gonna burn for that one. It's a good question. I mean, I'd love to say that I know the answer to that, but honestly, I've just been asking people that would otherwise be canaries in the coal mine, based on the nature of their business, because I feel like that's really all that I can trust, in terms of I can watch the news all day long and hear about, this math, this economist, interest rates, blah, 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 blah. It's like, that's really good. But honestly, I've been keeping my ears to the ground, listening to the clients that I feel like would be leading indicator people. So, people that are in residential housing, people that are in retail, kind of in the two places that I've been asking questions about.
Yeah, that's good.
What's been interesting is that I am thoroughly confused, admittedly, that depending on who you talk to and what they are using in the tools in the public domain is to make that determination. And I even have talked to a friend of mine, high school, college friend of mine, who she's the one who does the trades, and so the hedging and everything else on behalf of her clients, and trying to and asking her, is there a rhyme, reason, pattern? She's been doing this obviously for a long period of time. She's my age, and so and still I'm just, after talking to her, I'm even more confused. So I don't know. Nobody really has a crystal ball, but and then also it just depends also if you're listening to Fox or CNBC, or what channel or show you're listening to. Again, as I've said in the past, that you listen to something, there's a story, and depending on who you're listening to, you wouldn't know it's the same story. So but yeah, I unfortunately don't have any crystal ball insight into any of that.
I like Adam's approach the best because I agree. So Derek says the reason I ask is the experts are all over the board. Goldman says 0% chance. Moody's 65%. WSJ seems to be at 100%. Unfortunately, it seems like we may be talking ourselves into a self-fulfilling prophecy. It's interesting when in 07, 08, I was in private equity, and we had holdings across a number of different industries, but we had holdings in shopping malls of all places, unfortunately, but natural gas and some other things that, we thought natural gas, that's going to be a great one. Well, then the bottom fell out on it too. But we felt it in 07. We could see it in the commercial real estate world. We saw a lot of that, and those guys were rumbling and they were nervous. And so they're like, we got to diversify. So that's where we went into some natural gas plays and some medical receivables and all kinds of stuff like that. Well, then, the crap hit the fan in 08, and nobody saw that one is going as deep as it did, but we probably should have known. I mean, given some of the speculation that was going on, et cetera. But what was interesting is I was brought into a turnaround of an insulating glass manufacturing company that does the glass sandwiches for residential remodel windows, so vinyl windows in particular. It didn't hit them until 2011. They were rocking and rolling even through 08, 09, and 10. They started feeling it in 10, but cratered in 2011. Banks called the notes. They were just about lights out. So it's just interesting to see what Adam's talking about. I mean, there is a canary in the coal mine effect. So anyway, and I think regardless, the best thing that we can do is run our companies as tight as possible, batten down the hatches, and have some provisionary plans, and maybe even some opportunistic plays if you have been able to squirrel away some stuff and increase your credit lines and stuff like that, in case, people start having fire sales in your industry. So Derek has another question here. I've seen several situations where an owner winds up selling before they were ready, like impulsive decision to sell, health issues, unexpected death, and wind up selling for far less than a prepared company would. How do you approach those conversations, and when do you think the right timing is to begin preparing? Ooh, great question.
I mean, it's if you got further clarity, Derek, fire up, and I'll hit the preparation fee piece first. If you could maybe hit the fire sale, what happens in a fire sale, Jack? Because you probably have had to deal with those more than I have. But on the preparation piece, I mean, it's Pollyanna statement to say always be ready to sell. But I mean that really is a true statement, because if you have your company always ready for sale, chances are you're making more money anyway, because it's a well-run company and you're focused on the right things, like, making sure that you're, kind of at your theoretical max of, generating operating profit, making intelligent decisions about investments, cutting those off when necessary, keeping a healthy balance sheet, not too much, but not too little. I mean, if you, having kind of goals, metrics, all that kind of stuff in place. But all that said, when people say, hey, when should I start thinking about a sale? I mean, there's kind of 5 years is always like the rule of thumb, meaning like, hey, start thinking about 5 years. In my experience, that's really because you're not going to treat it like a full-time job. But if you're going to treat it like a full-time job, probably 1.5 to 2 years is the minimum length of time necessary that you need to spend getting your crap together, getting stuff buttoned up, having some preliminary conversations about where you got value leaks, and putting stuff in place to mitigate them. 1.5 to 2 years is the minimum length. 5 years is kind of the rule of thumb that we all go by.
Yeah, and I would say, and we've seen an uptick in this, and I think it is because of COVID. I think prior to that, when the economy was kind of moving along, it was that people were waiting and then they panicked. So you have people that were maybe in their minds already on a 2-3 year plan that got delayed, and now they panicked, and the value of their businesses are less than what they thought it would be or what they wanted it to be. And so I've talked some people out of selling and doing some introspective thought process as far as, are they really ready to sell? Are they panicking? Obviously not superseding their own psychology or mental health, and that if they are really ready to sell, then that's what they want to do, and we'll proceed. But it is and we talked about brokers versus investment bankers, and so I think that depending on the size of the business, if it's appropriate to have an IB involved, they will help through that process as well and getting you ready, and initially do an assessment as to where you are in that process. So I've told clients that I see kind of a 3-4 year horizon for you guys, because of the things that I see that you are doing or are not doing, or opportunities that may be coming about. And again, I don't have a crystal ball, but I just say this is kind of what I've seen in my experience. And so you may want to consider that. And then others who, okay, I understand that, or it's urgent, et cetera. So let's and they feel overwhelmed as to, oh my gosh, I'm being told I have to do all these things. Well, let's take baby steps, and let's, knock out, make a list, a priority list, and start knocking things out. Who should be doing what? You, the owner, should not be doing all of this remediation to your business. You can't. It's just not, because then if you're doing that, and if you're the best salesperson, then you should be out doing sales. You shouldn't be in the back office trying to fix things and you should be considering things like, okay, do you have the appropriate personnel in the right places deployed accordingly? So if you have, an accounts payable and accounts receivable person, well, this is a very simplistic example, but, combine that. Or if your payroll costs are significant, maybe you bring some of that process in-house and then have the payroll company implement that process. So it's things like that becomes, so for me, it really the great legal answer, the escape route for attorneys, it depends. And so it really just depends on where you are in that process of business organization internally a lot of times.
Yeah, I hope you don't mind it that I plagiarized in the post this week about trying to double as, be channeling the spirit of Jack. And when I was writing it and like using legalese, it depends. You've taught me well, Jack. Oh man. It's funny. So as we get ready, here, hold on. We got another question, I think. Oh no. So back to your note, Derek, it's funny when Adam was saying we say 5 years. Adam and I worked on a client that just sold this last year. They weren't planning on it. They didn't really even want to, but it was opportunistic. But 4 years ago, I started coaching them, and then I brought Adam in, and they became a CPA client, but they sold for over 5 times more this year than they were offered 4 years ago. And they tripled their top line, they quadrupled their bottom line, but they got systems in place and they had the right people doing the right stuff. And so it took time. And he didn't really want to sell. He didn't anticipate that he would sell, but it was actually, the timing was amazing in their industry. But nonetheless, one thing at a time, man. Let's see. Cautionary tale I use as a prominent real estate investor here in Charlotte, passed away years ago, had done some very, very little planning. So the company was severely impacted by issues with ownership, taxes, and nearly didn't survive. Interesting. There were so many things that weren't done to prepare, including estate planning, company transition preparation, that the high cost and time that it took to clean up the mess was eye-opening. Whew. Yeah, I think we can all nod our heads and think about various scenarios that we've experienced too. Thanks for bringing that up, Derek. Appreciate it. So Jack, you got a list, man. Tell us about this list of the top, what is it? Top 10 failed mergers?
Yeah, so actually top 11, I'll probably I won't go through all of them, but it was, kind of doing a little bit of research into kind of looking into this and just to bring my knowledge up to speed. Very interesting article. I'm happy to share it with others, but it was published in May of this year. Top 11 mergers and acquisition failures of all time. And so there is a Starbucks card on the table for the first person that gives me a one-word answer as to what they believe is the number one cause of failed M&A transactions.
Ooh.
I mean, it's kind of obvious, but there's several choices. So
close. But that's not it. Ego is one of them.
So
research, close, but that isn't the answer.
Let's see.
Research and ego. Oh. Someone has nailed it.
Someone, I can't see who that is.
Michelle.
Is Michelle. Okay. Congratulations, Michelle. You are absolutely correct. All right. Yeah, I better write that down so I don't forget. I want to keep my word that I owe her a Starbucks card. Okay. So in no particular order, I thought maybe I was going to try it if I had time, put it in chronological or value. So and some of these will sound familiar to you, and no surprise, but so the first one, America Online and Time Warner, $165 billion deal back in January of 2000. And they go through kind of the positive and negatives. And then so you guys know I don't like reading, but I'm just going to read because it's efficient. Apart from the catastrophe, the two companies had significant cultural challenges that due diligence failed to reveal. So then they separated into two firms less than a decade after the deal closed. The next one is Citicorp and Travelers Group, $83 billion in 1998. The commentary is cultural integration issues arose as a result of the merger. The most significant issues were inflated cost, outdated technology, and employee retention following the merger. So I would say that, culture is part of it, and maybe an after effect of that is, or an impact of that is employee retention. It's okay. If you infuse, and one of the comments, Gary, that you had for me before this was, and actually I think it's in the post, is a merger really a merger, or at least a merger of equals? It usually isn't. And so which culture dominates? And in rare cases, the smaller culture dominates in that there is a realization that they do it better. And maybe that's why we're acquiring them, not just for the hard assets, but also for the culture and the processes and procedures. But in most cases, it is the David versus Goliath, and Goliath's culture is going to prevail. I see that interestingly in my wife's industries, in the medical industry, pharmaceutical industry, as to when she has experienced a couple of those where the company that she was with was acquired or is the acquirer. And how did that integration work beyond the technology? And you'll see here in a few examples, there was a technological, mechanical issues, but in most cases it is, well, wait a minute, this person who is now my boss doesn't understand how we do it here, which is different than what they do, but it works for us. And that's why we were profitable. And that's why they wanted to bring us on board and acquire us in a lot of cases. In the pharmaceutical industry, it's interesting because a lot of times they're acquiring a new drug or a new area of medicine that they want to integrate or bolt onto their system. So, all right, the next one, which Gary, I know you're very familiar with, Daimler-Benz and Chrysler, $37 billion, deal closed in 98. And the commentary is, sadly, this was another case of culture or corporate culture clashing. The two organizations were never integrated and the project synergies went unrealized. And another interesting comment, this transaction was initially viewed as a merger of equals, which we all know is never the case. It slowly became a takeover of Chrysler by Daimler, and Daimler was rumored to be aggressive when telling Chrysler how things should be done. The two organizations ended up not getting along and continued to run as separate organizations. The merger was a disaster, and this deal has gone down as one of the most famous M&A fails in history. And I don't know if you want to, I'll pause there if you want to add any colorful commentary to that, since you were involved in that.
It was super depressing for me. I had a big project. I actually did the brand strategy of the launch of the Sprinter van, which is those tall vans. Now they are badged Mercedes, but in 2001 they could not be badged Mercedes in the US because of dealer bylaws and whatever. And so the dealers didn't want trucks on their lot. So the strategy was, all right, Freightliner was also part of that portfolio, so was Dodge, etc. What do we do? And so our recommendation was badge it Freightliner, do not badge it Dodge. And they eventually, and so they followed it initially. They did badge it Freightliner, even though you open up the hood and there's the TriStar logo inside on that diesel engine. But man, when I was working with the two of them, the Germans, like, I've got German heritage, right? Precise. It would be this way, and like very emphatic, and they were very exacting. The Chrysler Corporate, I mean, those guys were fast and loose, and it was all about cheap, drive down the price, get the price on the components cheap. And they were, cigar smoking, 2 martini guys, it was very, very different. And I remember being so depressed going, man, everything that I believed about culture being so important, evidently my kind of resolution was, I guess you get so-and-so big, you just slam them together and they work. Well, it fell apart in, what was it, 07, 08, when it finally just completely blew up. And, all this shareholder value lost, et cetera, and a lot of time, but it was all culture. It was all culture. They could have worked together, but they were just so different. The Germans, that exacting standard stuff, and, let's squeeze down suppliers to get the lowest price. And I think Adam has worked with some of those guys up in Detroit too. It's just a different world, but it's all culture.
All right. This one probably familiar to many of you. Sprint and Nextel, $35 billion in August of 2005. And the commentary is that, and this is what I referenced a few moments ago, the two company networks did not share the same technology and had zero overlaps, making integration a nightmare. They also found it difficult to merge operations and had clashing market strategies that allowed rivals to steal dissatisfied customers. So there is another one that we haven't talked about, which is, okay, clashing market strategies, visions of the future, how to do it, when to do it, kind of thing. And there's another example that I have. And then as a further commentary on the culture, Sprint was bureaucratic, Nextel was more entrepreneurial. Shortly after closing, many employees and executives left. So another, I guess, kind of short message there is, what is the impact of a merger on employees who, maybe are strong with one culture, maybe are kind of set in their ways and are not willing to change or evolve. I mean, part of this is viewed as an evolution by some, as to what is the next step, combining and then moving forward in a combined fashion. But what we're seeing is more of a failure because there is a propensity to the dominant culture tries to take over the less dominant, or the I guess, is it recessive? I don't want to say that word. The less dominant culture.
Submissive.
Yes, submissive. Yes.
Hey, before you keep going, one thing to think about. We do this actually at BGW. I've been involved in a number of these where we'll do a cultural compatibility assessment before the deal is done. You've done your numbers and all that, but as you want to go down that pike a little bit further, it's typically a 2-day process. But what I've done is we bring in the management teams of the two organizations. We get into core values. We get into who's going to do what in the new organization, a 100-day plan. I mean, it's pretty intense for a couple of days, but we've had deals where our CEO really wanted this deal and the leadership team went, nope. And he acquiesced, which was good because it would have been a really bad deal. And then really good deal where everybody went, yeah. And that entity is still rocking and rolling. And we did that integration in 2006. So a little bit of money up front can save you a lot of pain too. But that's one of those areas that you can't wing it, and you can't be in an ivory tower thinking, oh, well, it'll be just fine. Rarely is it.
Yes, and that is an awesome segue into the next failed merger with respect to ivory towers. So Viacom and CBS Corporation announced a blockbuster $35.6 billion merger in 1999. And so Viacom, the combined company's name was headed by Viacom chairman Redstone and CBS's president Mel Karmazin. Okay, so it says the deal was excellent on paper, but was viewed as scary by Senate antitrust subcommittee members. CBS was mostly a broadcast, both TV and radio, while Viacom's strengths were in film and cable TV. So the commentary is, but the deal didn't turn out as planned. I feel like I'm telling a story now. After the merger, Karmazin, who is the CBS president, had a hard time working with Redstone on whether or not the company was making enough big bets on future technology or blockbuster movies. So in this instance, you have two separate, literally medium coming together, and maybe different perspectives as to what is the best method of getting and distributing that, and also creating content that they couldn't agree upon. So so what are they going to roll the dice on, essentially? And that is the top two people. And if they can't get along and share a vision, there's no way that anything is going to happen good, because it's all that bitterness and everything else and disassociation is trickling down from the top, and gravity's just going to take it all the way down to the bottom. So so very interesting with that. The next one is Alcatel and Lucent, and this was a $13 billion transaction merger in April of 2006. The reason why this one was interesting on the list is you were talking about, so far talking about essentially U.S. culture and business culture. This one is you're combining a European and American company, and says both cultures often clashed. The Lucent executives found it hard to adapt to Alcatel's corporate culture, and another big barrier was language. So, and I thought there was a comment in here that the person they selected to be the head didn't speak French. The French company, and they appointed a CEO who did not speak French. I mean, that seems like low-hanging fruit and a no-brainer, that you got to speak in the person's own language and not,
Oh, it'll be fine.
Oh yeah.
Details.
Yeah. Hopefully the translator gets it correct, or well, I was going to say Google Translate, but in 2006 there was no such thing. So at least I don't think so. All right. HP and Autonomy, October 2011, $11.7 billion. HP bought this data firm, intending to make it the centerpiece of a plan to transform HP from a computer and printer maker into software-focused enterprise services firm. So taking big, clunky, well, I guess at that point they weren't so clunky, but taking hardware and going into a different space of software where they really hadn't been in or really even known for. Commentary is the deal quickly turned sour as HP reported that the value of Autonomy was $8.8 billion within the year of purchase due to fraudulent accounting practices. Remember, the purchase price or the value was $11.7 billion, which dropped to $8.8 billion. So essentially a $3 billion delta because of fraudulent accounting practices that were not found out, obviously not disclosed, but not found out in the due diligence process. And even though you might have a bank, an insurance, meaning an insurance policy in the form of identification and post-closing funds, et cetera, to deal with those kind of things, I mean, $3 billion, I don't think anybody reserved that for that, right? So massive lawsuits were generated from this transaction, shareholders sued, et cetera, so totally blow up. Another familiar one, Kmart and Sears, November 2004, $11 billion. This one is interesting because the statement is that even though Sears and Kmart are two of the most iconic names in U.S. retailing, combining struggling companies is hardly the recipe for success. Analysts say this was a double suicide deal. So they basically helped each other kill each other by going through that. All right, and let's see. I have a few more. We have a little bit more time. So I'm having fun. All right. So
hey, let me interject one
Yes.
thing, because we got a comment in here from Bruce that I thought was pretty interesting. So it's only partially related to mergers and acquisitions, but also driven by government intervention was the TARP legislation in late 2008, the most effective legislation in our memory. My understanding is that Secretary Paulson drafted it as only 3 pages in length. Oh, that's a little bit different than the pages of all kinds of stuff, implemented in days, may have saved the world from financial environmental meltdown. And as I understand, every one of the loans was paid back on time or early with substantial interest payment to the federal government. Did it also save investors in the acquired institutions like Merrill Lynch from a fate and pain of bankruptcy process? Good question. That's a good observation. It's one of the times where I guess the government, because will freely bash stuff that's not being done right, but that actually worked.
Yeah, and a lot of
Adam?
times they're expected to bail them out too. They don't create the problem, but they exacerbate it, and then it's like, okay, government, spend a bunch of money with a bailout.
Yeah. You have anything you want to weigh in on that one?
Not anything more than to reconfirm what the feedback was, which is, at the end of the day, the government made money on the deal. So that's amazing. That some good companies, it'd be great if they were independent, could they still exist, all that kind of stuff. And I can debate, Dodd-Frank and, new capital ratios that banks have to maintain all day long. But at the end of the day, did the government make money or lose money? The government made money, period. Like, there's no debating that. That's just a fact. And I think, and if you look at precedents, they made money on the auto bailout that was also part of that package. They made money when they bailed Chrysler out back under Lee Iacocca.
Mm-hmm.
So I don't have heartburn necessarily on bailouts, because it's kind of been proven that, we don't come up in snake eyes on that. I think where the government's come up snake eyes has been, hey, let's bet, let's bet on specific technology companies, and we're going to dump investments into that. I think, yeah, right.
It was a way better looking car than a Tesla, but
no, I know, but I mean, that's a good example, Gary, of like, that's where, when we're picking winners and losers, from an investment standpoint, that appears where we have the problem versus, too big to fail bailouts being a problem. And, frankly, it's like, I always like to use the TARP bailout as an example of like, idiot armchair quarterback, what was a freaking alternative?
Right.
Like, seriously, like, in other words, you can't predict what the alternative was, and it seemed like it was probably going to be very, very bad. Like, I've heard zero people have critical commentary on TARP. And at the same time, there probably is legitimate commentary on, as much as I liked it for a lot of our clients, were the last two COVID bailouts really necessary or not? That's like one of those, hard to say on those, because they were a lot of, to put it in context, each one of those was like 5x TARP. And at the time with TARP, we're like, oh my God, what are we thinking with this? It's the biggest bailout ever, which was really a loan that was going to get repaid versus free money, which is what we have now. Again, I'm not complaining as a server to a business owner. I'm saying that, and I'll address Derek's comment. I am saying that, as a taxpayer, this could be kind of rough to pay this one back. But to the comment on TARP helping bad actors at the expense of good actors, my opinion, I'm pretty opinionated on that, Derek. I think that if you look at it as kind of 80-20 rule, I think that it did help out. I think that it ended up helping the 80% of the good people. And I think, frankly, you kind of pointed them out in terms of the same players that were in your hit list of, people predicting recession. There should be some people with freaking Goldman Sachs that should be in jail right now that are not, related to the packaging of bonds, you know, and all the mortgage stuff that they did, you know, and it said other people just got caught up on it because it's because you were relying on people who had a reputation to portend to know what they were doing, when in reality they were betting against you. And that's bullshit. Sorry about my language. I do think there are some people that should have gone to jail. Like that is one of the travesties of that era, is that nobody went to jail for any of that stuff.
Yeah.
Yeah, and somebody should have.
The Big Short is a great movie.
That's right. Great book too. I mean, it kind of breaks
Watch
it down.
it and read
Yeah.
it.
Yep.
I started shaking, and my wife, you know, she's like, what is oh man, because I lived through it when our PE firm blew up. I mean, it was way too close to home. So anyway, we got 3 more minutes. Keep rocking,
right.
John
All
or
right.
Jack.
I'm going to go fast. I got 2 more that I want to get through, but I want to be mindful of everyone's time. All right. April 2014, Microsoft and Nokia, $7 billion. The two companies first formed a strategic partnership in 2011, so 3 years prior, that resulted in all Nokia smartphones running on the Windows Phone operating system. A year before the acquisition, Nokia was considering a move to Android and would, in theory, leave Windows with no OEM support. So the CEO of Microsoft at the time was looking for a way to enter the mobile phone industry to better compete with Apple and Google. However, acquiring Nokia didn't change the harsh reality that Windows phones have only a 3% market share. Very few people love the phones, and Android phones held 79% market share. The year after the deal, Microsoft wrote off $7.6 billion and had to lay off approximately 25,000 employees. So, you know, pretty large scale. And then in 2016, Microsoft sold Nokia to a HMD, I guess that's an equity company, for $350 million after the $7 billion merger, right? All right, and last one, eBay and Skype. eBay acquired Skype Technologies for $2.6 billion in September of 2005. It was a massive overpayment considering Skype's revenues were only $7 million. However, eBay's CEO justified the acquisition, that claiming that Skype would improve the auction site by giving users a better platform for communicating. So in this example, you have a company anticipating buyer consumer behavior and taking a bet on it. The optimistic CEO projected an increase in eBay's transaction volume by making it easier for buyers and sellers to talk using Skype's technology. But what she didn't realize was that buyers liked the anonymity. Kind of begs the question is, why don't you just ask your customers what they want before you go spend a ton of money? eBay users all ultimately rejected Skype's technology and considered it unnecessary for conducting auctions. 2 years after the acquisition, eBay informed the shareholders that it would write down the value of Skype by $900 million. So, although there's a footnote, however, unlike the other transactions listed, this deal was not a total disaster. In May of 2011, eBay was able to sell all of Skype's equity to Microsoft for $8.5 billion. And due to eBay's 30% stake at the time of sale, the company realized a net gain of $1.4 billion on its original investment in Skype. So, bad start of the story, bad middle of the story, but apparently they recovered pretty significantly. So good ending to that story and good way to end the list.
So it's like a terrible round of golf, but you remember the one good shot you had. Hey, I got 150, but man, I had that one good drive. It sure was good. That's my golf game. All right. Well, we are at the top of the hour. Thank you, everybody, for joining us. We're going to finish out the year next week, week 140, going deep on the deal, because there's so much money out there being chased, and we want to talk about kind of bulletproofing and getting ready. You had some really good questions today about that. You know, what are the things that we can do? And we've touched on some of that earlier in the year, but it was actually, believe it or not, almost a year ago when we were talking about that, back in January, February. I went back into the archives. So anyway, if anybody came on here late, We will put this up on the BGW CPA YouTube channel later on this afternoon. Adam, it's always good to have you. And it was even good to hear a little cameo of Chewy on the front end. That is, next time you got to have a cameo of the visual of Chewy, because that is one cute little dog.
Yeah,
And
I'll make sure that to somehow put as my picture. She has a nice little Christmas outfit now. It's just it's ridiculous. So yeah.
Oh, speaking of outfits, I just can't stop laughing. But so I invited Gary to the Toys for Tots gathering, and it was an ugly sweater gathering, and he wasn't able to come, but he sent me photographs of what he might have worn that evening. And my response on text was, I have no words. I'm just like, my brain is melted. My eyes are disoriented. So you would have definitely won. And my response was, you would have ended up with a lot of women's and men's phone numbers to follow up with. So yes, I'll leave it at that. And so it's very interesting.
it's going to have a cameo again.
Wasn't a whole lot of materials to that outfit, actually. So
oh, there's a lot more to it than you think. All right, guys, thank you so much. Have a great rest of the day. Enjoy a little of those peaks of sunshine while they're out here before we get more rain. So take care, y'all. Bye-bye.
thank you.
All right,
Bye.
see you guys.